Previously, inside the vault.
Technical analysis is a trading discipline used to identify trading opportunities by focusing on historical price patterns and stock trends.
Once the support is broken, meaning the price falls below it, a good support level will then become resistance.
A trend in the stock market is just the overall direction of the market or stock's price. Uptrends connect a series of higher lows, creating a support level for future price movements, while downtrends connect a series of lower highs, creating a resistance level for future price movements. Because trends come in many forms. You have the tide, the waves, and then you have the ripples. What's going on, family? It's your favorite headless YouTuber back again with a brand new video. As always, before we get into it, let's get it started with some Monday motivation. Life isn't about waiting for the storm to pass. It's about learning to dance in the rain. It doesn't get easier, you just get stronger. In today's video, we will add another element to our technical analysis tool belt, candlesticks. So far, when looking at the charts on TradingView, we've been looking at the line version of the chart, which is fine, but it's not nearly enough. Candlesticks give a lot more detail into the price action of a stock. Today, we will break down what they are and what they tell you. If you're new to the channel and like what you see so far, show us some love by liking the video, subscribing, and making sure notifications are turned on so you don't miss any new content. Also, in case you missed the previous announcement of our new free course, The Mind of a Master Trader, you still have the chance to access it for free by clicking the link down in the description below. The information in this course applies to stocks, futures, forex, and even cryptocurrencies, and is sure to take your investing and trading to the next level, regardless of your level of experience. It will only be available for free for a limited time, so act now to receive access. Without further ado, let's get into the video. Before we dive into the anatomy of the candlestick, I think it's about time we talked about the two market mindsets, the bulls and the bears. If you've watched or read anything about the stock market, you've probably seen or heard the thing about these two. These terms describe how the stock markets are doing in general, that is, whether they're increasing or decreasing in value. And as an investor, the direction of the market has a huge impact on your portfolio. So it's very important to understand how each of these market conditions may impact your investments. A bull market is a market that is running or increasing in value. During a bull market, investors often have faith that the run will continue over the long term. On the other hand, a bear market is one that is falling. A market is usually not considered a true bear market until it has fallen 20% or more from recent highs. An easy way to remember the difference between the two is that bulls attack in an upward motion and bears attack in a downward motion. Although some investors can be bearish, betting on the market to fall, shorting stocks and buying puts, the majority of investors are typically bullish, betting on the market to rise, buying shares and calls for stocks. Ready for a pro tip?
No, not really.
Of course you are. As a trader, we recommend never limiting yourself to just being a bullish or bearish trader. You want to be able to keep your options open and trade with versatility, switching up your approach based on the market condition. Write this down. Trade what you see, not what you want to see. All right, what is a candlestick? Let's talk about it. The candlestick at first glance basically tells you where a stock has been over a specific period of time. Every candle gives you 4 pieces of information: the opening price of the stock during that time period, the closing price of the stock during that time period, the highest price that stock reached during that time period, and the lowest price that the stock fell to during that time period. The range between the open and the close is represented by the body of the candle. When the close is higher than the open, the candle will be green because the stock's price increased. This is called a bullish candle. On the other hand, when the close is lower than the open, the candle will be red because the stock's price decreased. This is called a bearish candle. The high and low points are represented by the wicks on the candle. Regardless of the color of the candle, the upper wick will always represent the high point and the lower wick will always represent the low point. Pro tip: When looking at the wicks, realize that a wick represents the range that a stock's price failed to hold during that candle's time period. They're called candlesticks because the wicks are meant to show where the price was burnt out. Wicks are great for finding strong levels of support and resistance. Looking at this candle, we can know that it opened here at, let's say, $10 and fell as low as here at, let's say, $5. Then it rose as high as here at, let's say, $25 before coming back down and closing here, which we'll say is $20. We know that the open was here and the close was here because this candle is green. Remember, green is a bullish candle signifying that the price increased during that time period. During this time frame, the stock's price opened at $10, had a low at $5, a high of $25, and officially closed at $20. This is what candlesticks are and what they represent on a chart. Now, we won't talk about it much today in the interest of avoiding information overload. We just want to cover the basics of the candlesticks. But just know, certain combinations of candles can form important chart patterns that can also give you a lot of insight into what to expect from the price movement of a stock, essentially giving you the crystal ball on where a stock may be headed. We now know what the candlesticks tell us about a stock's price action over a period of time. But you may be wondering, what determines that period of time? You do.
Me?
Well, you and your trading strategy. The candle's time frame can be tweaked to your liking. You can choose time frames ranging from 1 minute per candle to 1 month per candle. The smaller the time frame, the quicker the moves, and also the quicker you have to be in order to capture those moves. Larger time frames give you a little more leeway in getting the move you want, assuming your analysis is correct. However, you would have to be more patient in waiting for that move to materialize. It's also important to note that the trends and signals you find on larger time frames are typically more dependable, and entries and exits are more precise when looking at smaller time frames. So we like to identify trends and price action signals on larger time frames like the weekly and the monthly candles, and find our entry points on smaller time frames like the 3 and the 15-minute candles. Of course, you want to cater your time frame choices to your trading strategy, but don't worry too much on your decision. Oftentimes, you'll be alternating time frames to accommodate different trading situations. The same rules and the strategies apply to all time frames. The only difference is, for 3-minute candles, they're going to change every 3 minutes. For monthly candles, they're going to change every month. That's the difference. The speed of the candles changes as you change the represented time frame. Okay, let's recap. The markets can be broken down into two sides, the bulls and the bears. A bull market is on the rise, and a bullish investor is betting on the market to continue to rise. A bear market is on a decline, and a bearish investor is betting on the market's downfall. Remember to allow yourself to be both a bullish and a bearish trader and trade what you see versus what you want to see. On to the candlesticks. Candlesticks tell you 4 things: the open, the close, the high, and the low. A green candle signifies a bullish move up, and a red candle signifies a bearish move down. The time frame each candle represents can be configured in the charting platform you decide to use, and which ones you use are completely up to you and your trading strategy. Use longer time frames for charting trends and smaller time frames for identifying entry points. Understanding the candlestick charts unlocks a new level of insight into the market that can truly take your trading to a whole new level. That'll do it for today's video. Tune in next week when we will conclude our beginner's breakdown of reading and understanding the charts. I promise, as always, you're not going to want to miss this one. Until then, remember, don't be afraid to fail, because it is in the darkness where we learn to appreciate the light. No battle is won without a fight. Failure should only change the strategy, never the goal. If you've enjoyed this video and want us to make more videos more often, you know what to do. Be sure to hit that thumbs up button below and subscribe to the channel if you haven't already. Don't forget to use the link in the description to get access to our free mini course, The Mind of a Master Trader, available for free for only a limited time. Also, comment below your thoughts and questions to let us know how we can continue to improve the channel. This channel and all of its content is made for you. Thank you for watching this video, and I'll see you in the next one.